So breaking the 30-year mortgage is continuing up. And I reminded you guys, whether it's mortgage rates, car notes, credit cards, all of that is tied to the 10-year. And so as we look, the 10-year Treasury has been on a tear. Well, yields have been on a tear up. Demand for these pieces of trash has been crashing. You cannot have debt levels at this high with yields this high. It is untenable. They can't, you're going to get to a point where the only way to pay your interest expense, just the interest you owe on the debt, is by printing money. And that is like entering full Ponzi-nomics, where they're just printing money out of thin air to make their interest payments. We are seeing Western civilization default.
Something is starting to break beneath the surface of the global financial system, and the market is beginning to feel it. Over the last few weeks alone, we've watched bond yields surge, mortgage rates climb again, and signs of stress spread across consumers, governments, and even foreign sovereign debt markets. At the same time, Bitcoin continues to hold global attention as institutional adoption accelerates, sovereign debt concerns intensify, and confidence in traditional finance weakens. What makes this moment so dangerous is that the system no longer has easy solutions left. For years, policymakers survived every crisis the same way: print more money, issue more debt, and kick the consequences further down the road. But according to Jack Mallers, that strategy is now reaching its breaking point, and when you step back and really look at the data, it becomes difficult to ignore. Americans are drowning in credit card debt, delinquencies are exploding, housing affordability is collapsing, and consumer sentiment is now worse than during the 2008 financial crisis and even the COVID crash. Meanwhile, Wall Street continues levitating near all-time highs because a handful of artificial intelligence and tech giants are masking the weakness underneath the economy. That disconnect between Main Street pain and asset market euphoria is becoming impossible to sustain. The average person feels poorer, angrier, and more uncertain about the future, while governments around the world are trapped inside debt spirals they can no longer escape without destroying the purchasing power of their own currencies. So in today's video, we're going to break down Jack Mallers' explosive warning about collapsing consumer sentiment, rising Treasury yields, global debt stress, and why he believes the world is moving toward a financial reset that could change markets forever. We'll also look at what this means for Bitcoin, for traditional assets, and for everyday investors trying to navigate one of the most unstable macro environments in decades. If you enjoy content like this, make sure to like the video, subscribe to the channel, turn on post notifications, and stick around until the end, because some of the implications here are far bigger than most people realize.
Consumer sentiment continues to fall. So this from Joe from Bloomberg: incredible how dismal consumer sentiment is now. It just keeps getting lower. UMich final was expected to come in at 48.2, which is already an all-time low, but it missed by a long while. It fell all the way to 44.8. So this is an all-time low consumer sentiment. Main Street, the everyday man, is in a tremendous amount of pain, as we've talked about week over week over week. This whole K-shaped economy is real. Tech continues to boom. The CapEx for AI continues to boom, but everybody else is in a tremendous amount of pain, okay? 44.8 all-time low. This is lower consumer sentiment than COVID, lower consumer sentiment than the 2008 financial crisis, lower consumer sentiment in the United States ever, all time, since we've been measuring it. So let's check in on consumer delinquencies. U.S. credit card accounts delinquent by 90 plus days, so 3 months of delinquent for credit cards, have jumped to 13.1%. That's the highest level in 15 years, and we're closing in on the highest level ever. Okay, this chart shows you dating back all the way to almost 2000, and U.S. credit card accounts that are delinquent by 3 months are about to reach an all-time high. So again, sentiment on Main Street is bad. You're having knowledge workers, white-collar workers getting fired due to AI. delinquencies through the roof, inflation is back. Across the board, not a good situation. They're going to have to print money at some point, or we're going to go through austerity. The whole system is going to fall apart. But fiat as we know it is running into some very, very serious issues. Hold on, let me pull up my speaker notes, because there was a post by Luke that I thought did a really good job. Here it is. So Luke wrote, we kicked the 2000 crash up to the housing market. We kicked the 2008 crash up to the U.S. Treasuries market. We kicked the 2020 crash up to the dollar. And so all of the debt and the borrowing and the misallocation of capital and the burdening to the common man keeps getting prolonged and prolonged and prolonged, kicking it up. So in 2000, that crash kicked it to the housing market. The housing market fell apart in 2008, kicked it to the Treasuries market. The Treasuries market fell apart during COVID, kicked it to the currency. And now the currency is the only escape valve that we have left. There is no more can kicking. They're going to have to debase the currency if they want to avoid austerity and a depression greater than any depression that humans have ever lived through, okay? This is Wall Street versus Main Street. I feel like this slide is a mainstay in the show week after week, is just showing S&P 500 continues to push towards all-time highs while consumer sentiment and Main Street continues to push towards all-time lows. If this doesn't scream to you that fiat is broken, it does not serve the people, it's not about equality, it's not about inclusiveness, it's not about proof of work and governed by Mother Nature and equal rights. It's not about any of that shit. There's nothing less American than fiat. There's nothing less American than the US dollar. As we sit here on Memorial Day, you'd have to sit and look at things like this and say, this is not American. This is not freedom. This is not democracy. This is garbage. And even if equal weighted S&P 500, by the way, is not at all-time highs. This is K-shaped nonsense. This is a very certain sector of the economy is what is holding the economic data together. It is what's driving the S&P 500. So when I say equal weighted, if the S&P 500, if all 500 companies had an equal weight to the index, but that's not how it works. NVIDIA represents a lot of the S&P 500, right? And so if you weight it how the S&P 500 is weighted, sure, all-time highs, but every other metric, Main Street, how everything, once you peel the onion a little bit, pull on the thread a little bit, you realize that the consumer is down bad, Main Street is down bad, the everyday man is down bad, the U.S. economic outlook is down bad, the U.S. bond market is down bad. They have to print the money. And, on a more optimistic note, how lucky are we to have Bitcoin? How lucky are we to have Satoshi Nakamoto handed us, gifted humanity, a engineered exit door?
What makes Maller's analysis so important is that he's connecting pieces of the economy that many people still look at separately. Consumer stress, rising defaults, treasury market instability, inflation, artificial intelligence-driven job displacement, and currency debasement are not isolated problems anymore. They're feeding into each other simultaneously. And the market is starting to realize that policymakers are cornered. Either they allow a severe recession and mass deleveraging to happen naturally, or they step in once again with liquidity, money printing, and intervention that further weakens confidence in fiat currencies over the long term. That's the real tension driving global markets right now. But the situation becomes even more serious when you zoom out beyond the United States. According to Mallers, the cracks forming in the global treasury market are now colliding with geopolitical instability, energy insecurity, and sovereign debt stress around the world. And once countries begin prioritizing survival over financial cooperation, the consequences for global markets could become extremely disorderly.
Turkey liquidated almost all of its treasury holdings in March. And so the reason we talk about things like the Strait of Hormuz is because global conflict and taking 20% of the world's oil offline has grave consequences. And I made this little sovereign Maslow hierarchy of needs visual. And why is Turkey selling its U.S. treasuries? Well, because you know what comes before U.S. treasuries on its Maslow hierarchy of needs? Things like energy, oil, food. if people are now, there are countries around the world putting in curfew, telling people to work from home, not get in their cars, basically not consume energy. And so if you're a country and you need to make sure that your people don't starve, or that your people can drive a car, get on a plane, turn on their lights, have air conditioning, not die from a heat stroke, you got to sell your assets. And as we've talked about, U.S. capital account, foreigners own a tremendous amount of U.S. assets. So if foreigners need to finance themselves in crisis, in war, in an energy shock, if global trade is being disrupted, they're selling U.S. assets, they're selling U.S. treasuries, they're selling U.S. equities. And herein lies the problem. The United States has greatly depleted its SPR, its Strategic Petroleum Reserve. And you can think of that as like, we've talked about dollar swap lines that the U.S. provides. Like, hey, don't sell those treasuries. Remember when the UAE asked Scott Bessent, Treasury Secretary, UAE said, hey, Scott, if you don't give us a dollar swap line, we're going to have to dump a bunch of treasuries and the yields are going to go soaring. Treasuries are going to crash. And he was like, okay. Here's a dollar swap line. Highly inflationary, printing the money. But just to avoid things from collapsing, like, please don't sell. Like, there's not enough buyers for you guys to be dumping all of these treasuries. Here's a dollar swap line. You can think of the United States using its SPR, its Strategic Petroleum Reserve, its oil reserves. You can think of that as like an oil swap line, because what the United States is doing is we're depleting all of our reserves to ship out oil to other countries so they don't do what Turkey did, which is just dump their treasuries to help their citizens live. I mean, we saw, a country like Australia, a developed nation, run out of oil. They had to run to Singapore and beg to buy their oil. And it's because Australia imports their oil from China, and China put in restrictions and said, we're not exporting any oil right now. All the oil we're producing, we're keeping to ourselves. Australia ran out of oil. And you're seeing developed nations, countries that we've all probably lived in, visited, going through early stages of crisis. And so this is going to be very disorderly for the Treasury market. If I go back, no wonder the U.S. 10-year yields remain above 5.5% and look like they want to keep going higher. No wonder mortgage rates are getting higher. So it's a very like dominoes, very cyclically. So the 10-year goes higher, 10-year goes higher. Mortgage rates go higher, consumer sentiment, people stop spending, economy gets worse, receipts come in lower for the country, receipts come in lower. That means true interest expense comes in higher than receipts. That means they got to print the money, the currency gets worse, Main Street gets worse. It boom, 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 boom. It feeds on each other, it feeds on each other, it feeds on each other until you inevitably get a crisis. And I'm not going to predict when that crisis is coming, but as you'll see, my market update is, like, as much as things stay the same, which they have, what's the same? Strait of Hormuz is still closed. The conflict is still ongoing. Global trade is still disrupted. Sovereign debt markets are still in a tremendous amount of pain and nearing crisis. Countries are still dumping treasuries. Consumer sentiment is still at lows. So all of that remains the same week over week. But this is not a natural state to persist. This is not a natural state to persist. And, this episode has to be short, so I'm not going to get into it, but having gunshots at the White House, these are topics that we've talked about on a week-over-week basis, is that if you have consumer sentiment at these lows, when you have such a wealth gap in the country, when you've eviscerated the middle class, when your industrial base is no longer, you get political violence, you get assassination attempts. It is really not a situation that can persist. And so something is going to break, something has to change.
One of the biggest takeaways from this entire discussion is that we may be entering a period where governments lose the ability to maintain the illusion of stability without increasingly aggressive intervention. For decades, confidence in the system depended on the belief that central banks could always step in, stabilize markets, and restore order. But every rescue came with a cost: more debt, more leverage, more dependence on artificially low interest rates, and more currency creation. Now the bill for all of that excess is starting to arrive at the same time globally. And unlike previous cycles, there may not be enough political, monetary, or economic flexibility left to absorb the shock cleanly. At the same time, this explains why Bitcoin continues attracting attention from institutions, corporations, and even nation-states despite enormous volatility. The appeal is no longer just speculation. Increasingly, investors are looking at Bitcoin as protection against a financial system that appears structurally unstable. When Mallers talks about Bitcoin as an engineered exit door, he's speaking to a growing fear that traditional savings, bonds, and fiat currencies may continue losing purchasing power as governments attempt to manage impossible debt burdens. Whether people agree with that thesis or not, it's clear that confidence in the old system is being questioned more openly than ever before. And this is where things become especially important for viewers watching this video today. Markets can remain irrational for long periods of time, especially when liquidity is still flowing into equities and risk assets. But underneath the surface, pressure continues building. Rising yields increase borrowing costs. Higher borrowing costs weaken consumers. Weak consumers hurt growth. Slower growth worsens government deficits, and larger deficits eventually force more intervention. That cycle is exactly what Mallers believes the market is underestimating right now. Not because collapse is guaranteed tomorrow morning, but because the long-term trajectory is becoming harder to reverse without major consequences somewhere in the system. The next few years could end up defining an entirely new era for global finance, investing, and even geopolitics. And whether you're bullish on Bitcoin, cautious about the economy, or simply trying to understand where all of this is heading, these conversations are becoming impossible to ignore. So let us know what you think down in the comments below. Do you agree with Jack Mallers that the financial system is approaching a breaking point, or do you think the economy will stabilize before things spiral further? If you enjoyed this video, make sure to like, subscribe, and share it with someone who needs to hear this perspective. Don't forget to turn on post notifications so you never miss an update, and be sure to check out our other videos covering Bitcoin, macroeconomics, and the future of global markets. Thanks for watching, and we'll see you in the next one.